The recent announcement of U.S. tariffs in April 2025 has sent shockwaves through global financial markets, creating significant volatility and uncertainty. The U.S. government declared a sweeping 10% universal tariff on all imports, accompanied by targeted tariffs as high as 145% on specific Chinese goods. In retaliation, China imposed tariffs of 125% on U.S. imports, reigniting trade tensions and exacerbating market instability. As a result, major U.S. indices such as the S&P 500 and NASDAQ have entered bear market territory, with a staggering $6.6 trillion in market value wiped out within days, marking one of the largest losses in financial history. Amidst the turmoil, Coldware, a decentralized cryptocurrency focused on privacy and real-world asset integration, has defied the downward trend seen across traditional and digital asset markets. Contrary to the weakening of most cryptocurrencies, Cold has surged in value, capturing the attention of investors and analysts. Its resilience is attributed to its unique decentralized infrastructure and privacy-centric solutions, appealing to investors seeking stability and innovation in uncertain times. This shift in investor sentiment towards decentralized alternatives like Coldware suggests a potential rethinking of investment strategies, highlighting the growing interest in diversifying portfolios with assets that offer both growth potential and a hedge against traditional market volatility.
Nvidia has announced plans to manufacture its artificial intelligence AI supercomputers in the United States for the first time, marking a significant shift in its production strategy. The company will utilize over 1 million square feet of manufacturing space in Arizona and Texas to build its specialized Blackwell chips and AI supercomputers. This move is part of an ambitious investment plan aiming to develop up to $500 billion in AI infrastructure over the next 4 years. Nvidia's decision aligns with the Trump administration's push to bolster U.S.-based chip manufacturing, a strategy recently underscored by tariff exemptions on certain electronics, albeit temporarily. This strategic shift by Nvidia is expected to enhance the company's supply chain resilience and meet the surging demand for AI technology. By manufacturing domestically, Nvidia aims to create hundreds of thousands of jobs and significantly contribute to the U.S. economy. The company's initiative is also bolstered by a broader $500 billion infrastructure investment in AI by the newly formed Stargate partnership involving OpenAI, Oracle, and SoftBank, focusing on expanding data centers and energy resources in Texas. This development underscores the growing importance of AI infrastructure in the U.S. and its potential to drive substantial economic growth and technological advancement.
President Donald Trump has announced a potential pause on the 25% tariffs imposed on the auto industry, aiming to give car manufacturers time to adjust their supply chains and increase domestic production amidst significant market volatility and global economic instability. This decision marks a shift from Trump's earlier stance on maintaining permanent tariffs and reflects a broader pattern of tariff policy reversals intended to mitigate economic and political repercussions. Major automakers like Ford, General Motors, and Stellantis support the move, emphasizing the importance of a thriving domestic auto industry. The announcement has led to a modest increase in financial markets, with the S&P 500 rising by 0.8%. Although it remains down for the year, interest rates on 10-year U.S. Treasury notes remain elevated, reflecting ongoing market uncertainty. The temporary relief also extends to electronics, with tariffs on products like smartphones and computers being eased, benefiting tech giants such as Apple and Dell Technologies. This has resulted in stock price increases for these companies. Although market analysts warn of continued volatility and uncertainty due to the administration's unpredictable trade policies, internationally, the tariff adjustments have impacted global trade dynamics, with ongoing negotiations between the U.S. and the European Union, and tensions with China and Vietnam. The temporary tariff relief has provided companies an opportunity to strategize around trade tensions, but future tariff impositions remain uncertain. This evolving situation underscores the complex interplay between U.S. trade policies and global economic dynamics, highlighting the delicate balance between protectionist measures and stable international trade relations.
Amid recent stock market volatility, concerns are rising among Americans regarding the impact on their 401k retirement plans. These employer-sponsored plans, which allow employees to save a portion of their compensation on a tax-deferred basis, are crucial for the financial security of millions, particularly older individuals nearing retirement. The market's erratic behavior has understandably caused anxiety about potential losses in 401k balances, which are typically invested in diverse financial instruments, including equities. However, financial experts like Ronald Premeroso from Western Governors University suggest that unless individuals are near retirement or require immediate access to their funds, there's generally no cause for alarm. Historical data indicates that despite short-term fluctuations, the stock market has consistently delivered average returns of around 9% over the past 3 decades. The significance of 401k plans in the American retirement landscape is underscored by their widespread adoption, with $8.9 trillion held in these accounts as of September 2024. The plans gained popularity following the Revenue Act of 1978, offering a supplemental retirement savings option alongside Social Security. Employers often match contributions, enhancing the appeal of these plans, which are managed by major financial firms such as Fidelity Investments, T. Rowe Price, and Charles Schwab. With market-linked investments, 401k values are susceptible to market trends, but the long-term perspective remains optimistic. For those concerned about immediate market downturns, it is advised to consult with financial advisors to strategically manage retirement savings, ensuring alignment with personal financial goals and timelines.
Goldman Sachs has issued a positive outlook on retail giants Dollar Tree, Home Depot, Best Buy, and Target, despite ongoing challenges such as tariff pressures and margin fluctuations. Analyst Kate McShane highlighted that Dollar Tree Inc. (DLTR) and Home Depot Inc. (HD) are well-positioned to manage the impact of tariffs from China, with strategic pricing and cost management expected to sustain their value offerings. Dollar Tree is particularly focused on maintaining its appeal to middle and lower-income shoppers who are experiencing financial strain, while leveraging strong spending from upper-income consumers. A successful holiday season has bolstered Dollar Tree's momentum into the first quarter, particularly in seasonal goods, despite the temporary setback from the loss of its Marietta distribution center. The analyst has assigned a buy rating to Dollar Tree and Home Depot, with price forecasts of $86 and $421 respectively. Home Depot's strategy involves careful import scheduling and experienced cost teams to mitigate tariff impacts, with a focus on seasonal goods. The company remains vigilant about potential downturns in housing activity, though it has historically seen increased activity when mortgage rates stabilize around 6% to 6.5%. The recent acquisition of SRS has proven beneficial, contributing significantly to Home Depot's revenue and enhancing its pro offerings. Meanwhile, Best Buy, BBY, and Target, TGT, face potential price adjustments to offset tariff impacts and meet future earnings estimates. Best Buy may need to increase prices by up to 9%, while Target might require hikes of up to 17%, though these figures could be mitigated with strategic SG&A reductions. Both companies have received buy ratings, with price forecasts set at $101 for Best Buy and $142 for Target, reflecting confidence in their ability to navigate these challenges while maintaining profitability.
The Consumer Financial Protection Bureau, under Acting Director Russell Vought, is undergoing a comprehensive review of its past guidance documents, with plans to rescind those deemed unlawful by the Trump administration. This internal memo, circulated to CFPB staff, directs a halt on issuing guidance documents that allegedly create unauthorized rights and obligations. Vaught's directive involves a detailed examination by the heads of 8 CFPB offices. including enforcement and legal, to identify which guidance documents align with newly established principles. These principles emphasize that guidance should not impose binding obligations beyond existing laws and must include disclaimers clarifying their non-binding nature. The move reflects a broader Republican critique of former CFPB Director Rohit Chopra's tenure, during which the agency was accused of overstepping legal boundaries through its guidance practices. The memo suggests that Chopra's approach, particularly his actions near the end of the Biden administration, weaponized the Bureau against deregulation efforts. This regulatory shift is expected to impact financial institutions by potentially reducing compliance burdens associated with CFPB guidance. However, it also raises concerns about the predictability of regulatory expectations and the agency's role in consumer protection. As the CFPB redefines its guidance framework, stakeholders within the financial sector will need to reassess their compliance strategies to align with the Bureau's evolving regulatory stance.
Apple's potential shift of iPhone manufacturing to the United States remains unlikely in the short term due to prohibitive costs associated with domestic production. Under current U.S. tariff policies, Apple's production costs could surge by approximately $8.5 billion annually, according to Morgan Stanley. This would translate into a significant price hike for consumers, with the iPhone 16 Pro Max potentially costing around $2,300. Up from its current price of $1,599, the high labor costs in the U.S. and the lack of necessary infrastructure further complicate Apple's ability to relocate its manufacturing operations domestically, despite a $500 billion investment pledge aimed at influencing tariff policy. Apple's strategy to mitigate tariff impacts includes diversifying its supply chain. The company has already started shifting some production to countries like India, Vietnam, Malaysia, and Thailand, which offer more cost-effective manufacturing environments. In particular, Apple's efforts in India are noteworthy, with plans to increase the country's share of global iPhone production from 14% to 25%. Additionally, Apple is exploring expanding production lines in Brazil, leveraging existing facilities like Foxconn's Jundiaí plant. These moves are part of a broader strategy to ensure profitability and operational flexibility in response to evolving tariff challenges, while also negotiating with suppliers to secure more favorable pricing terms.
In the past year, Ripple's XRP has significantly outperformed Ethereum, ETH, and Shiba Inu SHIB in terms of return on investment (ROI). A $10,000 investment in XRP a year ago would have grown to $35,202.95, reflecting a substantial gain of over $25,000, despite a recent price dip to $2.09 per token. This performance was bolstered by legal victories against the SEC, which improved market sentiment towards XRP. In contrast, the same investment in Ethereum and Shiba Inu would have resulted in losses, with current values of $5,494.23 and $4,429.23, respectively. These figures highlight the importance of selecting robust assets in the volatile cryptocurrency market. Looking forward, Rexus Finance, RXS, is gaining attention as a potential high-growth investment. The platform's innovative approach to real-world asset tokenization and its strong ecosystem, which includes tools like Rexus Token Builder and Rexus Estate, have attracted significant investor interest. Currently in its final pre-sale stage, RXS has raised over $47.90 million, with analysts projecting a 35,000% increase in value over the next 12 months. This positions Rexus Finance as a promising contender for investors seeking substantial returns, potentially surpassing XRP's remarkable performance. As the pre-sale nears its conclusion, investors are urged to act quickly to secure RXS tokens before its official launch in June 2025.
Idaho Power has proposed a significant reduction in the export credit rates for non-legacy rooftop solar customers. affecting those who installed their systems after December 2019. The proposed changes would see the summer on-peak credit rate decrease from 16.99 cents per kilowatt-hour to 14.05 cents, while the non-summer rate would plummet from 4.8 cents to just 0.959 cents per kilowatt-hour. This adjustment is part of Idaho Power's annual filing with the Idaho Public Utilities Commission, intended to align the credits with current lower energy market prices and ensure equitable compensation for energy contributions to the grid. The proposed rate changes have raised concerns among solar panel owners, such as Hawk Solon, who invested $18,000 in solar installations with the expectation of reducing energy costs and promoting clean energy. The drastic reduction in credit rates could significantly impact the financial viability of solar investments for many Idaho Power customers, potentially extending the time required to break even on their investments. The move has sparked criticism from solar advocates who argue it undermines the financial incentives for adopting solar energy, potentially slowing the transition to renewable energy in the region. The Idaho Public Utilities Commission is expected to make a decision on the proposed rates by June 1st, with significant implications for the future of residential solar power in Idaho.
David Burrows, President and Chief Investment Strategist at Barometer Capital Management, has identified Wheaton Precious Metals, Expand Energy, and Cash as his top picks amid a challenging market environment characterized by narrowing market breadth. The firm has adopted a defensive stance, responding to market volatility exacerbated by tariff-related news and underperformance in heavily owned tech and semiconductor stocks. The market has seen a rotation towards inflation-oriented assets, with financials, precious metals, and non-U.S. global stocks outperforming. This shift is partly due to a weaker U.S. dollar and concerns about U.S. recession risks, prompting global investors to reallocate capital away from U.S. equities. Wheaton Precious Metals (WPM) is highlighted due to its strong performance driven by rising gold prices, structural inflation risks, and high government debt levels. The company benefits from a high-quality asset base with exposure to low-cost operations across 18 mines, offering diversification and reduced operational risk. With a robust balance sheet and zero debt, Wheaton has seen its dividend grow by 12% annually over the past 5 years. Expand Energy, EXE, the largest U.S. gas producer, has capitalized on its strategic position and synergies from its merger with Chesapeake and Southwestern Energy. Despite its leverage, the company is focused on debt reduction and is poised for dividend growth, having been recently added to the S&P 500. Barometer Capital Management maintains a significant cash position for flexibility, ready to deploy as market internals improve. The firm's current asset allocation strategy includes a substantial portion in cash and short-term bonds, precious metals, global equities, and North American equities. This strategic positioning reflects a cautious outlook on North American markets, while remaining constructive on global ex-US equities and commodities.